All right, so today the big one, right? Was today the decline that starts more of an intermediate pullback and ultimately could be another correction in this calendar year. We're going to break that down. Or was today so much of a down day that we're going to bounce? Like, have we set the low point because of how dramatic it was? Have we set the low point? Are we starting to bounce? So I'm going to break down what I expect will happen based off of what I'm seeing. I see signs for both. I see some signs for both. I see more signs leaning in one direction than the other. So I'll kind of break you down what I'm thinking there, and we'll take a look at like why we were so bearish here today, and really over the last couple of days, from yesterday's open, which was a 4-week high point. A new 4-week high point yesterday at the open to now nearly a 4-week low point, new 4-week low at the close today. So we'll break all that down, the intermarket relationships, the sector rotation, the breadth indicators, and how they're looking right now. We'll take a look at some technical signs, again, like I said, that are very, very telling, that we haven't seen for a while. So we'll break that down in terms of, especially in terms of the stages of buying opportunities and where we might be at there if we are at one. And then we'll take a look at our trade idea of the day, and how it takes advantage of what we're seeing right now in connection with all the other trades that we've been doing in the market outlook coming up to today. So, and how it relates to all of those trades to again take advantage of this inflection point that we're at here today. So let's go ahead and get started. Today is Friday, August the 1st, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or down here, or the red subscribe button down below. Click the thumbs up icon to like our video today. Comment on anything that stood out to you today. Share it with other people. Join our website at MarketScholars.com for free. You can subscribe to our basic subscription. Get our Market Outlook blog post. I'll show you here in a second. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. So today, being Friday, everybody gets access to this blog post. You can see it's got the video on it, the full-length video, as well as a lot of content down here about what's going on today, which I would love for you to comment and share down below. You can share it, right up above actually. You can share it with anybody. Down below here you can comment. You can click on that link and comment on the video down at the bottom. So there's a lot of content here. This is available for all of our basic subscribers. It's a free level subscription at Market Scholars. If you click on this subscribe button here at the top, where it says subscribe now, subscribe free, it takes you to this page. You can join for free for now, right now, and get access to these posts every day. Now they give you the preview videos here, the Market Outlook generally on Monday. For the most of the week, you get the preview videos on the free version of this. You can get access to our foundation level here by clicking on pricing under foundation. This foundation tier gives you access to our full, like this video that you're seeing today, our students get access to for every day. And it gives you access to all of our stuff. You can see this is where you sign up. You can sign up here just by clicking Join Foundation Now. You get 29 bucks a month. You also get 2 months for free if you do the yearly. You can join now. You also get access with that to our Market Outlook Live video. This is where we manage, every day we do a trade idea in the Market Outlook. We manage those trades on a daily basis here during a live stream, 3:30 Eastern Time. We do it every single day, and then we keep track of those trades with our trade tracker down here at the bottom. You click on this expand, and it takes a look at all the trades that we've done all year long. In fact, we've made over $10,000, on nearly $13,000 on all the trades that we've done since the beginning of the year. On a net basis, we've had winners, we had losers, but on a net basis, and we haven't had more than $13,000 at risk at any given time. So generally speaking, with $15,000 at risk, we've been able to put we've been able to make $13,000. So it's been a pretty good year so far, pretty good first 6 months, and that's what you get access to for just, again, $29 a month, or $299 for the full year. You can see that's well worth the gains that you get just from one trade on the full version of the video with the foundation tier. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator like we usually do. As you can see, we closed below the moving average. We closed 0.15 of a point below the moving average. We did not get a bull tag. We typically get a bull tag when you have a light pink shading the yellow line. So we have the yellow line, which is a close below a rising moving average or a close above a falling moving average. In this case, obviously below the rising moving average. The other half of that is the pink shading. So the light pink shading comes when the intermediate line falls below 80. And then the dark pink shading comes when it falls below 50. So you just need light pink shading, the yellow line, and we don't have that. The intermediate line is below its market sentiment. It is not below 80, however. Pretty bearish short-term sentiment. Again, technically this is another intermediate confirmation signal. So it would be the third one in the past 4 days. With the momentum line oversold, the intermediate line still strongly overbought. Even with its decline, it's still strongly overbought. The momentum, the near-term line now being in the reversal zone is not the best situation. And we'll see if we build on this or not. You can see a bull tag when you close below moving average just by a little bit. If we build on it, it can really keep going to the downside, right? You get your pullback, and in this case it was a correction. But if you just dropped, in this case you dropped significantly below it, and bull tag actually set the low point. So we could be in a situation right now where the weakness in the last 2 days has set a low point here. And I wouldn't say it was a significant low point, just like these. These were pretty good legs to the upside, but they weren't beginnings of intermediate declines. The beginning of intermediate rallies, is when we get dark green shading, and the green line. And this is where you came off of this low. There's the beginning of the intermediate rally, just like this one was over here. The bull tags just set new legs to the upside, or they end it, one or the other. But these were pretty good, like 8% moves. I don't think we'll get an 8% move off of this one. But we had off of the last semi bull tag type pattern here. We came up to about a 7.5% rally. So, can we get a pretty good run to the upside? For sure. But, also keep in mind that when you look at the zigzag chart here, we're already up 24% off of that low. And it's not really even off of the correction low. It's actually off of the first bull tag low that we got off of that correction. After rallying 9%, pulling back 5.5%. And then taking off to the upside to a large degree, and we've, really taken advantage of that during the June cycle and into the July expiration, and then now we're getting a little bit of weakness as a result. Pulling back still up above the prior correction high point, right? So we're still up above that, and also too keep in mind that this is one intermediate run. And let's activate this and throw this onto the high point since we're going off low to high. So there's your intermediate run. So a pullback doesn't start, it's just noise until you break the 23% retracement. In this case, this would be an intermediate decline because we're coming off, this has been an intermediate run. And so we're not there yet. 60, 50 would get us down to, a little bit below a 5% decline. That would be about a little bit below that. Looks like a bird just hit my window. A little bit below a 5% decline. And that's so you can get a red tag here because we're about halfway there without, breaking the 23% retracement level and getting into this this was a breakaway gap actually back here that we had, as well as a breakaway gap we had over here. That we had in May and then again here in late June. So with the runaway gap that we had coming off of this low point right there in late April. Is this a runaway gap to the downside? Very well could be. You can see, the characteristics you look for a runaway gap or any significant gap is a gap at the open that's one standard deviation, bigger, more than one standard deviation, in this case to the downside. And then a close of ideally about 2%. So, we're not really getting that. If you look at, back here in February, I believe it was back in this area, we had a gap to the downside and it didn't go. February 20th or 19th was the highest high, and then we kind of broke down here in March and got a gap to the downside and got a 2% decline. If you take a look at what it looks like here, we never really got a runaway gap to the downside here, and like I said, that first gap down was right there, and it had any kind of runaway characteristics to it. But like I said, this one was a runaway gap to the upside. Is this a runaway gap to the downside? They're not very common, and there's very much a possibility that that's the case. I don't think so, because we didn't finish down below 2%, and that's usually kind of like the sign that we're going to have some trouble. And we ended up closing, because remember, we gapped down almost a full percent, and then we ended up only down 1.6, considering how high the VIX ran, and we'll take a look at that here in a second. That's not that bad of a move, considering. Your NASDAQ 100, same pattern, right? You're getting closing below the moving average. Bearish short-term sentiment, but not too extreme. I mean, the near-term line is pretty bearish, but the momentum line is not too extreme there. You look at your Dow Jones Industrial Average, and we did get a bull tag here. Last bull tag led to a good run. You can see, or the one before that led to the intermediate decline, and that one also, similar to this, gapped down through the moving average, dropped, in this case, 1.5%. Today we're 1.25% below the moving average, and there you can see the bull tag. And then finally, your Russell 2000, again, bull tag, but we got that yesterday, and we built on it here today so far to the downside, and we'll see how this plays out again. The intermediate line, so we have the reason why we have the bull tags on these two, because the intermediate line is below 80. It's still at bullish levels. It's crossed below market sentiment. There are definitely red flags. There are signs of weakness, but not necessarily signs that we're breaking down yet, right? You have to kind of build on this, considering that we were only 0.1% below the moving average. You could really kind of say today is actually the bull tag, and again, we'll see if we like the expectations until you see otherwise, right? The expectations for bull tags are that you bounce up. Right, that's why they're called bull tags. Right, I mean, they can start intermediate decline, so they're very significant inflection points. And that's why we'll find out very quickly if we continue to build on this to the downside early next week. Then we'll know really quickly if this is a bull tag or not, bounce or not. But until then, we expect that we will, right? Because your risk is really low, and again, if you come off of this with an 8.5% gain, you're going to have some pretty decent returns as a result of that. Let's take a look at the weekly chart. In fact, let's go to the weekly market forecast, since this is the end of the week. And you can see, again, after getting a cluster last week, a engulfing pattern this week, the momentum line, I mean, this isn't a bullish intermediate confirmation signal. This pattern suggests that we'll probably bounce next week. Kind of similar to this pattern that we had over here in August of last year, September, where we had a significantly oversold momentum line. The near-term line, though, was not very oversold, and then we bounced right back up the next week. So there's just because we've had one down week doesn't mean we're going to have two. We can, right? But the momentum line suggests, like the last time we've come down to oversold levels, we bounced into a cluster on that one, and then the time before that we bounced up. It wasn't very strong, but we bounced up off of that low point. This is a little bit bigger range than what we saw with those two. You kind of go back to over here. There's a time where the momentum line dropped down and we kept going down. So this is something to kind of keep an eye on really closely. But again, this pattern itself suggests that we should expect that we'll bounce next week. If you take a look at the weekly chart, and this is the really important pattern here, because I talked about this yesterday. Here we are right on the cusp of 5%. We did not close 5%. We have a transition candle this week. Remember how we were talking about, we could get a transition next week. Nope, we got a transition this week. A lower close, a small body, an upper and a lower shadow. Is the candle bearish? Yes. So this is a bearish pattern, as we've seen across multiple indicators. And it doesn't necessarily mean we have to go down. If you look at November 4th right there, right here. So that was a bullish one to the upside. Where was the one? I think I was looking at these transition candles here in December, beginning of January. You can see they were all transitions, and we had a bearish one here the first of the year, and we rebounded. So we can rebound But then, again, look at that July 15th, the big bearish candle there above the moving average, and the Heikin Ashi candle was similar to what we see right now. So, like, this would suggest that next week is going to be a bearish week, especially with the, we've been converging for a while, and the size of the candle has been progressively smaller and smaller. So really important to see how next week goes. Again, we're going to open up at 6,300. We're currently trading well below the open, so next week's candle is going to at least start as a bearish candle, and then we'll see how we go from there. If you take a look, one other thing I look at for signs of reversal is the Hull moving average. So big breakdown there. Like, if we flip the parabolic SAR up, the 20-day Hull has turned red, but we're above the 200-day Hull, but we're moving down towards it. We're breaking down. So there's signs of weakness there. You look at the weekly and you're like, okay, well, there's still, like, we still haven't flipped the parabolic SAR up, right? On all these other instances, like in July, for example, the next week we flip the parabolic SAR up. So when we get these transitions that flip to the downside, here's another one over here in April, and we had one over here in July 31st of last year. We typically flip the parabolic SAR back up and we turn red. So we're not, like, we have to trade down to the line. Now, next week's is going to be a lot higher than this, so it's going to be possible, but we have to flip that parabolic SAR up next week. So that's something to keep an eye on. But it doesn't look necessarily like we're that close. We're close enough. And again, you can see you don't have to be like right on it. That one we flipped the next week. This one we were right on it and it flipped. This one we were right on it and we flipped it down. This one over here and some of these others we were, we're a little bit further away. This is probably the furthest away we've been for a transition candle if we were going to flip it. That means either this is a continuation pattern, next week we're going to bounce, or we're going to have a really down week next week. And again, so if I had to choose between one of those two results, I would still stick towards the former, unless we just continue to get baskets of data and earnings that would suggest otherwise. When you get like headline-driven weakness, from a jobs perspective, it's a pretty big headline. But again, we priced in a lot of that here today. We're only down 1.6%, so that's not a trend-changing drop in and of itself. Looking at the three green arrows again, we have three reds all across the board. Yellow line. We're barely below the moving average, so we can turn green really quickly on the moving average, and pretty much all of these we can turn green. The Russell's off of its lows. So there's again, a pretty decent chance that we bounce right. I mean, I have to expect that we'll bounce off of that until we don't. Again, that's what we talked about in our technical analysis class, that there are really good signals to bounce off of. The intermediate confirmation signal I told you before is a very short-term buy the dip kind of a trade. This is a little bit more intermediate term buy the dip kind of a trade, right? You get 5, 6, 7, maybe 8% leg higher off of a 3 red arrow bull tag signal. It's kind of the, they go in stages, and then the last stage being the red tag of 5% plus or minus a point or two on that zigzag chart usually leads to a double-digit return. So, we're kind of working through the stages of that right now, and until we see otherwise, until that red tag drops down, in this case it would have to drop some major support, as you see on the on this chart, that to get to 5% you have to come down into this area right there, a little bit below the 50, but holding the point of control, staying above the 200-day moving average. Very strong support. The Ichimoku cloud you'll see here is in this area. Very strong support here. So for it to go past 5%, it would have to take a significant change in sentiment. Some catalyst the market's not anticipating that would change that. So obviously we don't know if that's out there, but it's unlikely, right? It's less likely because especially since we've already had a correction, it's very rare to get multiple corrections within a short time frame. They usually take 1 to 2 years, so 18 months to 2 years. So they go only like 3 or 4 months to start a 10% decline, because usually the 10% declines, they fail on their bounces and we get corrections. They move to lower lows, breaking the 200-day moving average. A correction is when you break the 200-day moving average. Right now, it doesn't look like with this setup that we're likely to break the 200-day moving average. Can we come down here? Sure. But if we did, that would be, again, that third stage of buy signal, that would be the best. out of all of them because of the potential reward back up to the upside. Let's take a look at the DMI. You can see the DMI has turned, and we do have a bearish cross, and we are above 27. We're not below 25 in the positive indicator. So we went from way down to way up. Those are kind of moves that aren't necessarily the easiest to maintain, especially with the ADX already still strongly on the bullish side of things. If I look at the RSI and the CCI, the RSI has dropped below 50, has not dropped below 40 yet. So we'll see if we bounce off of that. You can see you can drop below 50 and still be bullish. It's dropping below 40 that turns it bearish. The CCI also has dropped below 100, but it hasn't dropped to these levels here where it's like, oh, and this is where you drop below minus 150 or down to minus 200. Now we're looking like we can get that kind of drop that starts an intermediate run to the downside. This is not it so far, at least. This is not it. You look at the Ichimoku cloud, we still actually have a mature bullish trend, and we're breaking the 26-day midpoint. We're slightly below the 26-day midpoint. You can again get below that midpoint and then bounce. So it either sets that low point, or then now we break the cloud, right? But remember, the cloud acts as a support. So that 602 area, and where the 50-day moving average is going to be right in here. So if we do fall down here, we end the trend. We do fall down here, and you're going to have some pretty good support at the cloud to bounce off of and continue to move higher. Let's take a look at the Bollinger Bands and the Keltner channels, and you see we have broken the 20-day average finally for the first time in a long time. Someone posted on Twitter that that's generally pretty bearish, so that's a very important pattern to keep in mind. We are not even in the lowest quartile of the bandwidth, however, and you can see obviously the bands are still outside the Keltner channels, and the momentum is waning but not bearish necessarily yet. If I take a look at today's intraday range, obviously a lower high and a lower low, closing way below yesterday's low because we gapped down. In fact, we had a little bit of a dead cat bounce here. So it wasn't quite your typical runaway where you just keep going. We dropped, we dead cat bounced, we started to go to lower lows, but we didn't actually really ever get significantly lower below the actual intraday low. And we came up off the lows by the end of the day. That's not typical, right? You typically don't get a lower shadow when you are with a runaway gap in this case. So that means that this gap is likely to get, I think that this is a common gap, and this is likely to get filled in, again, sooner rather than later, so probably early next week would be the expectation. You can see the size of the range is still really small. So like I've told you all week, we're set up for a move in the direction, in a big move, and we talked about that it's most likely going to be a move to the downside, but it doesn't necessarily mean that this is it. I think this is kind of a warning shot across the bow, so to speak, just to kind of let people know the bears are out there, even if they don't necessarily pull off the move today. They're there, right? They're in this area, even if the bulls are able to make a push next week to the upside. The other thing too about today is the volume was good and strong. It wasn't abnormal. 139 million. Again, not significantly below the moving. The range was only 7 points. I mean, it was above average, but that's not like trend changing range, right? When you look at 7 points is like right here. I mean, that's not huge. We're still below 1% on this, and that's barely over 1% when you compare it to the price. And like I said, the volume at 114 million is high, but it's about as high as the 52-week high. It's not extreme. It's not like breakout type range, kind of like what we saw back over here, where you had a 10-point range and the average was 6. That's a little bit more significant there. And then when you look at the volume, the average was 42 million on February 21st. If I were to go back to the volume over here, let's go out a little bit further. If I were to go back to the volume over here, so there's February 21st, you can see the volume down there was much higher. It was high. It was 1.5 times as the average. But for considering how low the average was at the time, that was a significant move, both in terms of the ATR and the volume, and for that matter, even the VIX. Let's take a look at the VIX chart. And you can see there on February 21st, back over here, the VIX, jumped, but it was still below 20. Here, the VIX is above 20, like above 20. Like this was a significant move to the upside on the VIX. We talked about that the VIX, I said earlier in videos, that the VIX was ready for a move, ready for this kind of move, right? Earlier today it was up to 27%. But even above 20%, these 20% moves on the VIX are not common. It's not common to get that. That wasn't even the case on February 21st. We didn't get up to 20%. And we exceeded that here. And, when you get these kind of moves that are 20% or more, we tend to come down. The volatility tends to come down. And I really wouldn't be surprised if that ends up being the case here. We didn't get up to 100%. So, we didn't break out there. Just for some perspective on that. February 21st is right here. So we weren't even above 90% there, and you can see we're closing just above, or we did not get above 95%. We did here. So I mean, is this the extent of the move? If you look at the VVIX, the VVIX did jump up to 109. It had it close at 110. If you look on February 21st, here let's look at the VVIX chart. Look at the VVIX here. So here is February 21st, right there. So you can see we closed at 105. Here we're already at the 110 level. So, are we hitting resistance like we did a couple of times already? There's a pretty good chance that that's actually the case, that we're just hitting up against some resistance here. And again, we'll know really quickly. Monday, Tuesday, the VIX usually jumps up on Monday mornings. So we'll see, just how much it goes up and how much the VVIX goes up, and then if it continues to go up from the open. All right, now let's talk about how the different intermarket relationships are functioning here today. So we'll go to our asset class comparison chart. You can see, the U.S. equities have been the biggest winner. So not surprising, they have a little bit of softness when there's volatility. You can see they were down the most. International stocks were not down very much, so they've held up a little bit better. Safety trades, gold, bonds, all up. The dollar was down significantly. So that's an interesting pattern because, again, generally speaking, that correlation is not positive. It tends to be negative. Now, in the short term, it actually has been relatively positive. It's slightly positive there. But again, generally speaking, when you look at it on a kind of a more of a typical time frame, the 3-month correlation, it's pretty negatively correlated. So it's kind of interesting to see how the market has responded to that. If there is continue to be weakness in the dollar, and one big reason why, we talked about this in our Q&A session today, one big reason why I think the dollar was bearish, sorry, not this chart, why I think the dollar was bearish today, because it was so far up above the moving average. This was the highest it's been above the short-term moving averages, the 8-day, in 5 years. So it tends to do this, right? When you get further away, it retracts to the mean. Really, currencies do that. They retract to the mean very quickly, and when they get extremes away from the mean. And so I think that's what the dollar did here, and we'll see if it changes direction. If it changes direction, considering again that typically negative correlation, that could be very positive for equities in the short term. Eventually, I think, though, the dollar has based and has set a low. Even if we retest it, I think it has set the low, and I think we are moving towards that 200-day eventually. So eventually, that might put some pressure on equities. I just don't think it's today, it's next week. I think softness in the dollar, if it continues, will actually be relatively bullish for equities, especially if the yields continue a little bit lower. Look at that drop in yield straight down to the bottom of the range. 4.25, remember, is the low end of the Fed funds range. Break below that, and now we're looking at some weakness, right? Some economic weakness. We saw that last fall when it broke below it, and we had the markets were really bearish for quite some time. We saw that here in April, and when we broke below the low end, the markets were really bearish there, washing out. So we don't want to break below 4.25%, and that's going to be a function of yields and of interest rate cut expectations. When we take a look here at the FOMC rate cut odds, I'll give it a second to come up here. There we go. So the odds for a rate cut now jumped. Remember yesterday they were, it was the opposite. The Fed Chair Powell had doused some cold water on those expectations, and we jumped up from 8% or 92% odds of a cut in September, or by September at least, to now only a 37% chance of a cut by September. Well, now we're back to 90%. So just like that, the odds of a cut have really increased, and your 2-year yield dropped dramatically, give it a second to load up here. Eventually. There we go. So down 27 basis points. You can see down to the low end. Really, just like that, in one fell swoop down to the low end of its range over the past so many months, and then going back to last year in September. So those are high rate cut odds, and as a result of it dropping as much as it did relative to the 10-year, the spread jumped up to its peak, at least the high end of its range. So again, we're at these levels where, okay, if we keep going, then the markets are just going to be bearish, right? The markets do not like a rising yield spread. They don't like it normalizing back up to 100, 150, 200 basis points. They don't like that. And if if the result of that is the rate cuts, remember with rates falling, the market doesn't want, as we saw here, as we saw last year, as we saw in April, the markets don't want rates to fall. That's not a thing. I know that's a thing right now, and from the administration and all that. But I don't know if they really care how it impacts the market per se, because yields falling, as we see, is not bullish. The yields fall typically during recession type situations. Even in 1819, when we weren't full on in the bear market, there were some economic, the yields were falling dramatically because things weren't so hot. And they did cut rates. They had the mid-cycle adjustment. International equities were doing very poorly from the beginning of 18 all the way through COVID. They were in a bear market, even if the U.S. equities weren't, thanks to the, whatever the Mag 7 stocks were then, that ultimately now, they are the Mag 7 stocks now. So we don't want rates to fall. We don't want, the fall in rates to lead to a jump in the yield spread. That's not bullish. So, it's one thing for the yield spread to jump up here because the 2-year yield is flat and the 10-year yield is rising because of strong economic growth and the Fed's not raising rates. Great. But if the Fed's raising rates, the 2-year yield is rising too. If the 10-year yield is rising, the 2-year yield is rising too, because the Fed's expected to cut rates to counter that inflation. So you see, kind of like it's a Goldilocks scenario. So the only other way, that's the only good way the yield spreads rise. The bad way is, again, the 2-year yield drops more than the 10-year yield because the Fed's considering rate cuts, and that's not good, right? As we saw here earlier this year, that's not good. As we saw last fall, that's not good, right? We did have a bullish run here at the end of the year, but there's some volatility in there. If you look at the end of the year going into January, or December going into January, we were pretty much bullish, but not without some ups and downs, right? Look at that weakness that we had there, the end of December, beginning of January, when we had the yield spread rising there, right? So we don't want the yield spread to rise. It's at a resistance. If it were to falter back down again, hit this resistance rollover, then again, that suggests that we might have another leg higher in equities. And I think that's where we're at, because again, if we break through these highs, and if we normalize at 100 basis points, 150, 200 basis points, that's bear market, right? That's typically what bear markets are made of. And, I don't think any of us want that. And I don't think necessarily we're there yet. Just some bad revisions and one bad jobs report doesn't necessarily get us to that point yet. Though it does seem like again, it's been a long time since the last bear market. We've had a lot of corrections since the last bear market, but it's been a long time since that great financial crisis low. And just like from 82 to 2000, we're ripe, right? We're ripening. But we were ripe in 97, and we still had 98 and 99 and the beginning of 2000. And so, how far into the ripening are we? Nobody knows until we start to see more and more of the stages of the market go through the bear market stages, the preliminary stages. Let's take a look at the breadth today. And not surprisingly, the breadth was pretty poor. The breadth has been like we've been getting the signs, right, all week long. All week long we've been getting the signs of bad breadth, and today was, you know, really bad. Like, it was the worst of all of them. We're almost back below 500. Remember, that's typically a sign we're in intermediate decline. So again, another kind of sign of weakness, red flag that's up there. Let's take a look at some of these others on stock charts, some of these other signs. We saw some yesterday, like the number of stocks above the 50-day moving average dropped considerably yesterday. Let's see, where is it at? Right here. It dropped considerably yesterday. Well, it dropped even more today. So now we're actually below the 50% mark at 250. So that's a pretty decent drop there. You look at the number of new highs, and you can see we are way down, way down. We never did get that Hindenburg-Ullman, because now remember the highs have to be above 72 too. That's way down on the new highs. So pretty bearish from that perspective. The bullish percent index, something else we look at for. I mean, that's a pretty significant drop too. If you look at the daily chart, I mean, this thing has dropped like a rock in the last couple of days. There's a number of bullish point and figure patterns in the S&P. We are like, the breadth is bad, right? The breadth is pretty bad. There's no getting around it. The number of stocks above the 200, still holding up above that 50% mark. So the ratio chart actually 275 over 249. It's not above 1. Well, it is now. It's up to 1 here. So this will be interesting to see. Again, if we break through, usually when you go up above the moving average, like we have been doing, that can be bullish, like it has been, but it also can be bearish here. So considering that, you know, we saw some weakness over here when we got up to 1, but then we kind of broke out and kept being bullish, you know, that's still a possibility. It's something to keep an eye on. And the other thing we take a look at is the trend. And the trend is dropping back down. This is the kind of looks at declining and advancing volume and relates them to each other. And it's looking like it's starting to roll over here. It looks like we're peaking on a high trend and starting to roll over. So not as bad. Like if you look at the advancing and declining volume, considering that here, let's refresh the page. Considering that you had basically 3 times as many new lows as highs. So you did now get above 72 this go around. You also had pretty decent. I mean, it was, you know, the declining volume ended up being about the same ratio. And so generally speaking, it's one thing, or in this case, you can see there, if you look at the ratio of new lows to new highs, about 2.25 to 1, and then you look at the declining versus advancing volume. And you can see it's also about the same. So, you know, it's a lot more bearish when this number is dramatically higher, when there's a lot more volume on the downside. So it's actually not too bad. That's what this was reflecting. One is, you know, again, they're equal. The ratios are equal. And we're you know, it looks like it might not have been totally updated here today yet. But you know, there is pretty decent volume, but not dramatically volume. That's when you're really like, you know, are concerned about these breakdowns, is when you get the dramatically high volume there. Finally, the new highs and new lows across both the NASDAQ and Composite and the New York Stock Exchange have dropped to negative levels and dropped well below 100. So that's a big drop. So again, that can lead to more, or it can be a dramatic drop that we just bounce right off of, like we saw back here last, you know, November of 2024. So you're all of a sudden you're bullish, and boom, you go bearish. That can set a low point. So this can set a low point. There's a lot of, you know, signs that it can set the low. You know, it's kind of dramatic and move enough to set a low point. But it, you know, there are some signs that we need to keep, you know, that it can be starting, you know, this bull tag, you know, and everything else, that it can be starting a bearish run. So it's a very important inflection point. And again, I lean more towards the former rather than the latter. I expect that we'll bounce until I see something different. If I see something different, and I'll know within a day or two, then, you know, again, the bounce will occur soon. We'll fill in that, as a common gap, we'll fill it in. The bounce will occur soon. If it doesn't occur soon, like if it doesn't bounce, then the pullback will take a while. So I'm not too worried about, like, am I going to be right or wrong Monday or Tuesday? I'm going to anticipate and expect, you know, a pretty decent move off of this low. And if it doesn't work out, then we're going to be in a pullback range for a while. And then we're going to have a really good setup at that point if we end up with that red tag, 5% red tag at some significantly strong support levels. Let's close up shop here on this segment with how the sectors are doing. So not surprisingly, your cyclical sectors were your biggest losers. But interestingly enough, they weren't that much of it. And like you can see, there was financials and energy were also down. I mean, every cyclical area was down except for your safety trades. A lot of your safety sectors are actually up today. It's kind of interesting to see. But yeah, your technology was down as you would expect, and they had a pretty. But if you look at the week, technology was not a big loser for the week. As bearish as we were, 2.25%, as bearish as we were for the week, technology outperformed. Communication services outperformed thanks to Meta mainly for that. You can see utilities was the only sector that gained on the week, 1.5%. And then it was all your other cyclical areas that underperformed. Materials down 6% and some of these others. So it's like, that's not really the kind of pattern that would suggest that we just peaked here, right? Because Monday was the first down day. If I were to go 728 and then come off the low point starting on April the 9th, you can see that technology and industrials were the biggest winners. So to have technology not dropping dramatically this week, off of the high so far, kind of suggests that maybe we're not necessarily breaking down here, because that's the sector, that's the most important sector in the market, because the three biggest companies in the S&P are in that sector, as well as a bunch of other really important AI-related companies are related to that sector. So I think there's another sign that I think, this is probably a low point that we developed today. And we might go down a little bit more on Monday. Again, typically does go down a little bit more on Monday. But then we'll see if we close at the low, if we get a lower shadow, and we rebound with that momentum line out of the reversal zone and bunch up. And again, that's kind of and we start to fill in that gap, even to a small degree on Monday. That's my expectation going into the new week. All right, that brings us to our trade idea of the day. You can see we closed out a few trades. Looks like Marvell Technology, which is one of our most recent trades, actually. And we closed out Shopify as well. So for some smaller losses right before they turn into more, since their max gains are kind of out of the range from a timing perspective. But we did put on Snow. So we have still a lot of bullish trades. You can see, not counting my trade in Snow. We have a pretty good delta, directional positively delta. So if we bounce up, we have some trades that can take advantage of it. We also have some bearish trades, like yesterday's PayPal trade, and then today we'll take a look at Snow. Let's take a look at Snow here. You'll notice that it broke down, right? It broke down pretty significantly. If you look at its market forecast, it's not looking so hot, right? It's broken below all these lows. You got light pink shading and a red line. As I said, the we're below moving averages. You've got a bearish candle on the weekly chart, a significantly bearish transition candle, again similar to what we saw over here when we were pretty strongly bullish on the PPO, and we still are now, and rolling over here, breaking below the 10-week moving average with that red arrow. I showed you the moving averages there. Let's take a look at some of these other oscillators. You can see eventually here. Oh, there we go. So the negative indicators up above 30, and the positive indicators slightly below 25. If you look at the RSI and the CCI, they are both showing bearish breakdowns. Below 40 slightly on the RSI, below 100 on the CCI. If you look at the Ichimoku cloud, we are into the cloud, right? And so we can move through that cloud. Now this will act as a support on the downside, but rate of change, again, we don't even have a trend yet. That's how how much this has moved. Like, we don't even have a trend developed here. And then, not surprisingly, we have broken below the lower band. See, did we finish below the lower band? Yeah, still finished slightly below the lower band, as well as just a little. We were below the lower Keltner channel as well, finishing just a little bit above it. But the momentum is turning bearish. Again, we have the red dot, so the bands we're still in the squeeze play, and the bandwidth's starting to rise. So I think there's an opportunity for that squeeze play to turn into something directional. So we'll sell that 180. You can see where the one standard deviation is. 180 is way down here towards the bottom of the value area. That's also where that 200-day moving average is. So we'll sell down to that level, see if we can get down there, getting a 2-to-1 reward to risk ratio if we do. So there's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Comment on the video. Scroll down to the bottom of the blog post. Comment down there. Comment on the YouTube video, right? Let me know what you're thinking. What stood out to you? What are you seeing? Do you see something that suggests we're going to be a lot more bearish, or do you see something else that suggests we're going to bounce off of this? Kind of like how I'm leaning towards right now. So post that down in the comments section. I'll reply to all of them. Again, thank you very much for watching. Remember to subscribe to our YouTube channel so you can get all the previews day after day. You can also subscribe to our website to get that full version of the blog that I showed you earlier. And you can also join our website. Subscribe for free to get that, right? And you can join our website at our foundation tier to get this full video like today, day after day, as well as the trade idea and the trade tracker where we track all those trades from day in and day out, as well as manage them in the Market Outlook Live. So subscribe there, like our video, comment on it, share it with other people. Follow me on social media, whether it's Twitter, Facebook, LinkedIn, StockTwits. Follow us there, like our content there, share it with others. Thank you again for watching. Have a great rest of your weekend, everybody, and we'll see you all on Monday.